Quite an upbeat, Beige book report from the Fed today. This won't do anything to discourage expectations for a December rate hike. Again, we're hearing modest to moderate growth reports from just about every one of the Fed's 12 regional banks, and a slight improvement in the outlook reported from business contacts. One other thing that is quite a bit new in this report, price pressures are strengthening in several of the districts. That's not something we've seen in previous Beige books, and in particular, there's reports of companies taking higher input costs and passing them on to their customers. We've seen quite a reluctance among firms to do that in the past, but now a little bit more willingness and ability, apparently, to do that. Won't necessarily resolve Janet Yellen's mystery over low inflation. It will take a while to feed through to the 12-month figures, but that is a glimmer of hope for people hoping that the inflation rate will rise closer to the Fed's 2% target. Now, all of this is happening in the context of an ever-tightening labor market. And this is something we're hearing over and over again from just about every Fed district. It's getting more difficult for companies to fill open positions, find qualified people, and that's restraining their ability to grow. One anecdote or one tidbit from this report that I have to share with you I think was quite eye-opening. This is from the Dallas Fed. Worker shortages were reported throughout the oil and gas supply chain and in construction. Similar reports came from manufacturing, healthcare, airlines. Some banks reported that labor was becoming a bigger issue than regulatory compliance. Now, you guys know you've heard a lot of complaining from banks in recent years about regulatory compliance burdens. And if labor shortages are getting tougher on banks than that, then you know it's a tight labor market.